Hey guys, my name is Greg Patrick and I am one of the co-founders here at Dividends and Income. If you're new here, we are all about sharing some of our best ideas for generating passive income. If you're not new here and you've been following us for a while, you're probably wondering what the heck happened to Jason Fieber and what the heck I'm doing here. Luckily for all of us, Jason hasn't gone anywhere. He's going to continue to do what he's been doing, talking about ideas and sharing strategies in the dividend growth investing space and the early retirement space. And what I'm hoping to do is to handle more of the income part. I am invested in dividend growth stocks, but not only dividend growth stocks. I also invest in a few other vehicles or instruments that help me generate between $80,000 and $100,000 a year in passive income. Now, that may or may not sound like a big number to you. I don't know what your personal situation is, but for me, it is exciting and it has been life-changing because that income now exceeds the income that I was receiving from my salary when I was working full-time, 50 to 60 hours a week. And what that's done is and why I say it's been life-changing is because it has freed me up to spend way more time doing things that bring me joy and perhaps purpose, and less time doing things that I don't really want to be doing. So this is just a glimpse into how building passive income streams has helped me personally. And the only reason why I'm sharing all of this with you is because I think that if I'm completely transparent with you, if I share specifically what investments I have made or that I'm making and that are working for me, that not only can I inspire you or encourage you, whether you're just starting off on your journey to build passive income streams or whether you're on it already, but also just because I think that I may be able to share, or at least I hope, that something that I've learned along the way and something that I'm doing, I can share with you that maybe introduces you to an income opportunity that you haven't considered before or that you didn't even know existed. And one of those opportunities is what we're talking about today, which is how to lend money to the government and generate high yield passive income each month. This is absolutely one of my favorite ways to generate passive income. It's as easy as buying shares of a stock through a regular brokerage account, except instead of buying a stock, you're actually buying shares of a special kind of investment fund that essentially lets you make high yield loans to the government. It's extremely passive on your part because the fund that you own does all the work. You just sit back and you collect the interest payments every month. I'll explain how all of this works in just a little bit. It's really easy to understand, and if you're someone that's looking for a new passive income stream, then this is a really neat opportunity. It's one that I have personally been doing for years, and I have collected tens of thousands of dollars in passive income since I've been doing it. So one of the really cool things about this investment is that you can actually get started today and you can start collecting income within the next 30 days. And you can get started for as little as $15, and in some cases even less, but I can safely say $15. So you don't need to wait a long time to collect your first interest check, and you don't need a lot of money to get started. In addition, the interest payments that I'm collecting on these investments pay out way more than what a typical dividend stock pays right now. Let me qualify what way more means. These investments are currently paying me double what the current yield of my dividend growth portfolio pays. These investments pay monthly, and so your money compounds faster than an investment that pays quarterly or semi-annually or even just once a year. So just to sum up really quick, these investments are easy to buy, there's a low cost of entry, they are high yielding, and they pay monthly. It really doesn't get much better than this for income investors, but wait, it does, because they actually offer tax benefits which can boost your income significantly more. In my case, my tax advantaged 5% yield from these investments pay me the same amount of income that I'd get from a taxable investment that yields 8%. I'll explain how that works in a little bit, but that is just a massive yield from what I consider to be relatively safe investment. And by their very nature of being funds, they offer instant diversification, which adds a level of safety that you don't get when you're investing in just one individual security. So what I've talked about so far is really just a very basic third grade level kind of introduction to these special investments. In just a little bit, I'm going to explain a little more. I'll tell you specifically what these investments actually actually are. I'll show you 8 benefits or advantages that I believe make them fantastic income investments, and I'll reveal the 4 specific investment funds that I personally own. And these are the ones that are paying me $1,275 per month in passive income. And if you stick around until the end of this video, I'm actually going to log into my brokerage account and I'm going to share my screen, and you can watch me if you want. I'm going to invest another $2,000 into one of these funds. I want you to see how easy it is to buy one of these funds, and so you can collect your first interest payment within the next 30 days if this is something that interests you, if it's something that fits your specific investment strategy and goal for your portfolio. All of that said, let's finally get into this. Just imagine that these are normal times, it's a beautiful summer, and you decide to go on a road trip to Western New York to visit some of its beautiful lakes and waterfalls. On your way to one of the lakes, you pass through a little city called Penyan. As you're driving down Main Street, Penyan, an asteroid suddenly falls from the sky and hits the road right in front of you. Fortunately, everyone is safe, but the road is hugely damaged. People keep driving by, but everyone is getting flat tires. The people complain to the city that the road needs to be fixed immediately. With a chorus of complaints and flat tires, the city decides they better fix the road. There's just one problem. The city doesn't have enough cash to fund the construction required to fix the road. So what can the city do to get funds for a project like this? They get financing from the investing public. They announce that they're going to borrow a chunk of money to fix the road, and in return, they promise to pay back the entire amount they borrow, known as the principal, on a set date known as the maturity date. And to get investors excited about lending them money in the first place, the city promises to make interest payments on that loan. To further help the city attract investors, the US government says that investors won't have to pay any federal income taxes on the income generated from the interest payment. The state makes the same offer. As an investor, I take the city up on this offer and I lend them the money. I then start collecting interest income on the money I lent out, and I don't pay any taxes on that income. Besides the interest income, the city pays 100% of my principal back by the date they promised they would. So that's essentially how municipal bonds work. And think about a bigger public works project. Now, I use the example of road improvement in a city, but really any kind of capital expenditure that a state or locality needs funds for can also apply. A locality could be a city, township, county, or school district. So if a school district needs financing to build a school, for example, they could issue bonds as debt for that project, and you can buy the bonds, lend them the money, and start collecting interest. What I've talked about so far are individual municipal bonds. Here's the thing, I actually don't invest in those. I invest in municipal bond funds. Just like how a mutual fund or an exchange traded fund trades under one ticker symbol and gives you exposure to a basket of stocks, a municipal bond fund trades under one ticker symbol and gives you a stake in hundreds and hundreds of individual muni bonds. So I'm not investing in individual bonds, I'm investing in a huge collection of them at one time by buying a bond fund. Now, there are plenty of benefits to investing in municipal bond funds, but for me, here are the 8 big ones. Benefit number 1, they're extremely easy to buy and sell. Muni bond funds trade on an exchange, so you can buy and sell them with a ticker symbol in your regular brokerage account, just like you would with a typical stock or exchange traded fund. At the end of this video, I'm going to actually buy shares of a muni bond fund in my brokerage account so you can see how easy it is. Benefit number 2, they offer a low cost of entry. While an individual bond usually requires a minimum investment of $5,000, you can start investing in a muni bond fund with just $15 or less. I say $15 because you can buy a single share of one of my favorite muni bond funds right now for around $15. I'll tell you more about that fund in a little bit when I go over the 4 muni bond funds I'm currently invested in. Benefit number 3, they offer high yield. The 4 funds I currently own yield an average of 5%. That may not sound like a lot, but it's actually double the current yield I'm getting from my dividend growth portfolio. And that extra yield adds up. For example, on a $100,000 portfolio, an extra 2.5% yield would pay you another $200 plus per month. On a $1 million portfolio, that extra 2.5% is an extra $2,000 plus per month. So it doesn't sound like a lot, but it definitely adds up. Just a side note, the payouts from muni bond funds are technically called distributions, not dividends, but the terms are really interchangeable. So whenever you hear me say distribution, just think of a dividend. I'll probably keep things simple though and just call it a dividend, even though technically it's a distribution. Benefit number 4, they're tax advantage. This is a huge one for me. Muni bond funds are tax-free on the federal level. That means that you don't have to pay any federal taxes on the income you collect from these investments. So you get to keep more of what you earn. Therefore, the higher the tax bracket you're in, the more attractive these investments are. I mentioned that the funds I own yield 5%, but when I consider the tax savings, that 5% is really the taxable equivalent of an 8% yield. There's a really good calculator at cefconnect.com which shows you the taxable equivalent yield on whatever muni bond fund you're interested in. Benefit number 5, they give you instant diversification. By investing in a muni bond fund, you're making one investment yet getting a stake in the hundreds, if not thousands, of individual bonds that fund owns. That means you can be diversified across different states, different counties, different cities, and you can be diversified across different types of projects too, like roads, highways, hospitals, water and sewer, airports, bridges and buildings, all in one fell swoop. Being diversified like this can help you avoid potential losses from being overexposed to a single bond. Even though muni bonds historically have extremely low default rate, there's always a risk that a bond you invest in can default. Bond funds help mitigate that risk because you're not putting all your eggs in one basket. For example, if you're invested in 5 individual muni bonds, all of equal value and yield, and one of them defaults, that's a potential 20% hit to your portfolio. If you're retired and you're relying on that income, a hit like that could be absolutely devastating, not only to your income, but also to your principal, because if it defaults, you're not getting it back. Compare that hypothetical scenario to what would happen if you're invested in a muni bond fund that owns 1,000 individual bonds. If one of those bonds defaults, it's not a big deal. One bond out of 1,000 isn't even 1%, it's a tenth of 1%, which really shouldn't hurt the fund or your income that much. Besides all this though, I also just like the diversification of having some exposure to bonds in general as an asset class compared to having a portfolio that's 100% allocated to stocks. So all around, muni bond funds can be a great way to diversify your portfolio. Benefit number 6, they pay monthly. The 4 funds I invest in pay me on a monthly basis. Since bills come in monthly, it's nice to have my passive income come in monthly as well. Besides that convenience though, all else equal and over the long haul, you'll actually make more money compounding monthly interest compared to compounding quarterly, semi-annually, or annually. Think about it. If you get paid next month, you can reinvest that money as early as next month and start the compounding machine that much faster than if you had to wait 3 months, 6 months, or even a year to get paid. Benefit number 7, muni bond funds are actively managed by a professional fund manager or management team. That means you're not doing any of the work or the research involved in tracking down and managing hundreds and hundreds of individual muni bond opportunities. The individual or the team managing the fund is doing that. They're looking at the bond's credit ratings, they're looking at yields, they're looking at maturities, they're looking at valuations, they're looking at potential risks, and they're managing all of those factors on your behalf to hopefully meet the objective of the fund, which in general is typically to deliver tax-advantaged monthly income to shareholders. Now, every fund charges a different amount, and for the funds I own, that fee, which is called an expense ratio, is absolutely worth it for me. Why? Because there are literally tens of thousands of bond issuers out there, which means there are tens of thousands of choices of individual bonds to invest in. I don't have the time, the skill, or even the desire to research and analyze all those bonds to figure out which ones are worth investing in, let alone managing them afterward. I want passive income, so I'm totally fine paying a small fee for the convenience of having a professional fund manager do all of this for me. The result is that with just one ticker symbol, I'm able to essentially hire a fund manager or management team who is actively managing a portfolio of hundreds and hundreds of individual municipal bonds for me. And since that fee or expense ratio is already baked into the share price, I don't even have to send the fund manager a check or anything like that. It's that passive. Everything is already rolled into the share price, and the yield I calculate based on the share price and the distributions, well, it's not skewed at all. Benefit number 8, muni bond funds can give clear buy signals. I'm not going to go into all the details now, but because muni bond funds fall under the category of closed-end funds or CEFs, these funds can trade at big discounts to what is called their net asset value or NAV. What this essentially means is that you can objectively look at what the value of the fund should be. Its net asset value is essentially its fair value. It's the value of all the fund's holdings. And so that means you can look at the current price and compare it to the net asset value to quickly identify whether the fund is currently trading at a discount to what it's actually worth, whether it's trading at its fair value price, or whether it's trading at a premium. So similar to how you typically want to buy a stock when it's undervalued, you want to do the same with muni bond fund, only it's a lot easier to identify when a muni bond fund is undervalued than when a stock is undervalued. Now, just like how some stocks seem to always be trading at a discount or a premium, the same can be said for some muni bond funds. So you'll want to compare their current valuation to historical valuation. For example, if the fund has rarely traded at a discount of over 5%, but today it's trading at a 10% discount, all else equal, now could be a great time to buy because it looks significantly undervalued. So the fact that muni bond funds are closed-end funds which can trade at irrational prices prices when the market gets out of whack is a huge benefit to investing in them. Recognizing these inefficiencies gives us opportunities to pick up shares for pennies on the dollar, lock in higher yield, and also have the potential for appreciation. This is a pretty sweet opportunity that really doesn't exist in an individual bond or stock. So those were 8 big benefits or advantages that I think make muni bond funds really fantastic income investments. All of that said though, these funds do come with potential risk or downside. I'll mention 5 of them now, and then I'll include some links to some good articles that talk a little bit more about potential downsides and how muni bond funds work in the description below, just in case you're interested in learning more. Downside risk number 1, your principal doesn't have a level of guarantee like it does when you invest in an individual bond. For example, if a muni bond fund is trading at $15 per share, that's essentially your principal or face value. Well, there's no guarantee you're going to get that $15 per share back when you decide to sell. Muni bond funds are closed-end funds that trade on an exchange, and the share prices are changing all the time based on supply and demand, just like with a stock. So the downside is your share price can decrease in value after you purchase. This is a real risk. The flip side is your share price can also increase in value. And since there's no maturity date involved with owning a muni bond fund, you can sell that fund whenever you want. You choose when you want to sell your shares, so that really helps tilt the odds in your favor a bit and help reduce some of the risk involved with these investments. But nevertheless, there's no guarantee you get your principal back, so you definitely need to be aware of that. Downside risk number 2, you're likely not going to see a lot of distribution growth like you would with a high quality dividend growth stock. You'll probably even see your distribution stay flat or even sometimes fall. These investment vehicles aren't really designed to pay shareholders increasing income. They're more designed to pay shareholders above average, tax advantage, current income. That said, I'm totally fine with the lack of distribution growth with muni bond funds because they're paying me so much current tax advantaged income. I personally like having the balanced passive income sources between my muni bond portfolio and my dividend growth portfolio. One pays me high tax advantage current income, the other pays me average current income, but offers income growth potential over time. Downside risk number 3, muni bond funds are sensitive to interest rates. When interest rates rise, the value of muni bond funds fall. Here's one way to look at it. Money always flows to where it's treated best. All else equal, consider that. Would you rather put your money in an investment that pays you 3% or 6%? 6%, of course. And if you had any money in the investment paying 3%, you would probably sell it and invest that money in the 6% yielding opportunity. Well, that's basically what happens when interest rates rise. Investors sell out of existing investments that are currently lower yielding, relatively speaking, and they put that money into new issues or new investment that, relatively speaking, are higher yielding. With money flowing out of the lower yielding funds, demand goes down and the share price falls. And that's how rising interest rates are a potential risk to your existing muni bond fund holding. Downside risk number 4, muni bond fund managers can use leverage to juice their payout. This is just an example, but leverage is how a portfolio that's made up of bonds yielding an average of 3% can actually pay you 5%. Here's a really general or simple way to understand how leverage works in the bond fund world. You borrow money at low interest rates with short-term maturities, and you invest that money into bonds that pay higher rates and have longer-term maturities. So you try to capitalize on the spread, and it's that spread or that difference between interest rates that can boost the fund's yield or the income that you're getting. Just to be clear, leverage in itself isn't necessarily a bad thing. If it's managed correctly, it's actually a benefit that I could have mentioned in the benefit section, but I'm mentioning it here to be conservative, especially because any instrument using leverage does come with risk. If the fund uses leverage and its total returns are positive, then leverage magnifies your returns in a positive manner. But if the fund's total returns are negative, then the leverage magnifies your losses, and that's why it's considered a risk here. Downside risk number 5, defaults. While extremely rare, municipal bonds can default on their repayments of principal and interest. Again, we help soften any blow from a default by holding several hundred individual bonds at once through investing in a muni bond fund. I will say that bond issuers have a ton of incentive to make their payments and not default. Once they default, it's incredibly difficult to get investors again and get finance. If they default, they get a poor credit rating and they have to offer really high interest rates to attract investors to their bonds. So they really do whatever they can to make sure they don't default. Nevertheless, default is obviously a risk, and so I'm mentioning it here. So those are the 5 biggest risk or potential downsides that I see with investing in municipal bond funds. Personally speaking, all 5 are acceptable to me or tolerable, which is why I'm so comfortable investing in them. And so now for some of the fun stuff, which specific municipal municipal bond fund investments have I made, am I currently invested in, that are paying me the $1,275 per month in passive income? That's what I'm going to go over right now. At the time I'm recording this video, I'm invested in 4 municipal bond funds. The first up is the Nuveen AMT-free Municipal Credit Income Fund, ticker symbol NVG. As I record this video, I own 5,967 shares of this fund, and those shares pay me $390.84 per month. Right now, each share costs $16.25, and the fund pays a dividend of about 6.5 cents per share. To figure out its forward yield at today's prices, just multiply its monthly dividend by 12 and then divide that number by the current share price. 6.5 cents times 12 divided by 16.25 is a 4.84% yield, which is awesome. But it gets even better because, as I mentioned before, municipal bond funds are tax advantaged. So here in the United States, we don't have to pay any federal income taxes on the dividends we get from these funds. In general, your tax benefits depend on your tax bracket. The higher your tax bracket, the more tax savings you get, which translates into a higher taxable equivalent yield. In the case of NVG, my taxable equivalent yield is actually 8.18%, which is just huge, and one of the main reasons I've loaded my portfolio with municipal bond funds. NVG gets me exposure to about 1,000 individual bonds, so it's diversified. The bonds owned in this fund are laddered, so some of them have maturity dates just months away, while others don't mature for decades. In fact, one of them goes all the way out until the year 2058. Don't be scared how far away that is. Remember, since this is a bond fund that trades on an exchange, I can sell my shares whenever I want. It's really simple. I don't have to worry at all about maturity dates. The fund manager does all of that. With NVG, I've got exposure to bonds issued from all over the United States. Most of them are in Illinois, California, Colorado, Texas, Ohio, and Pennsylvania. And I've got exposure to bonds across sectors like healthcare, education and civic organizations, transportation, water and sewer, consumer discretionary, long-term care, and utility. Through the fund, I'm basically able to loan money to everything from a children's hospital in Akron, Ohio, to a university in Mobile, Alabama, to a transportation project in Long Beach, California. Just to dive a little deeper, let's look at that last project I mentioned. One of the bonds this fund invests in was issued by the Alameda Corridor Transportation Authority, or ACTA, in Long Beach, California. That project is a series of bridges, underpasses, and street improvements that separate freight trains from street traffic and passenger trains. The project is intended to help make the transportation network in the area more efficient, and as a shareholder of NVG, we're helping to fund the project in exchange for collecting interest payments on our loan. So we've essentially loaned money to this project, but how does this project make money? How are we going to get our money back from them? They need to be able to produce some kind of revenue in order to pay their debt obligations, which are to their bondholders like us. And I'm only going to go into a little detail on this to help you understand some of the big picture. As investors, we're loaning our money and collecting interest, but we want to make sure that whoever we're loaning our money to is creditworthy and in a position to pay us back the principal plus the interest on the loan. So what I'm actually going to go through with you right now is something that the fund manager would be doing. I don't do this. I don't look at individual bonds like this. The fund manager does that. I rely on him or her to do their due diligence with this stuff, so I don't have to. Again, I'm just showing you an example to give you an idea how this works. So getting back to the question, how does the Alameda Corridor make money? Well, I pulled up their most recent basic financial statement, which was audited, and here's what I found. The Alameda Corridor charges the railroads use fees and container charges. That's where they get their revenue from. And in the event that their revenues from those fees don't cover their debt obligations, the ports of Los Angeles and Long Beach pitch in funds to help cover the shortfall up to a certain percent. Corridor operations began in 2002, and with the exception of 2012 and 2013, the corridor hasn't needed the ports to help with any shortfalls in revenue. So the main risk here is if usage drops. And that's a real risk in a pandemic like now, where there's just a lot less commerce happening. So I dug a little deeper, or I tried to, because I was curious what his usage looked like lately, given how much commerce has slowed down this year. And here's what I found. This is a letter from the interim CEO of the corridor at the time that's addressed to the ports of Los Angeles and Long Beach. I won't read everything here, but this letter was dated at the end of March, which is really near the beginning of the pandemic. And at that time, the corridor was giving notice to the ports that as long as volume stayed at or above 50% of last year's volume at the San Pedro Bay port, that they shouldn't need any help in paying the debt due on April 1st, 2020 and October 1st, 2020. I don't know what happened, if they were able to make the April 1st payment on their own or not, or if there was a shortfall and they needed help from the ports to service the debt. I guess I could actually call the corridor and try to find out, but I just really wanted to show you kind of a little more deeper dive into how all of this works. Keep in mind, this corridor project is just one of over 1,000 projects that you can have a stake in when you buy shares of NVG. So moving on, and I'm not going to spend this much time on the next 3 muni bond funds I own. I'm actually just going to list them kind of quickly. The second is Nuveen AMT Free Quality Municipal Income Fund, ticker symbol NEA. As I record this video, I own 5,581 shares of this fund, and those shares pay me $315.33 per month. Since I pay no federal income tax on these shares, my taxable equivalent yield is 7.77%, which is massive. The fund is currently trading at a 7.7% discount to its net asset value. At first glance, that may seem like a fantastic discount, making right now a fantastic time to buy shares, but it's actually traded at an 8.98% discount on average over the past 52 weeks. And glancing back over the past 3-year and 5-year time frames, it looks like it pretty much always trades at a discount. So I'm not in any rush to buy shares here. I'd probably wait until its discount to NAV gets into at least the double digit. The third is Invesco Value Municipal Income Trust, ticker symbol IIM. As I record this video, I own 5,300 shares of this fund, and those shares pay me $296.80 per month. My taxable equivalent yield is 7.9%, and the fund is trading at a 7.95% discount to NAV. That's less of a discount than its 52-week average of 8.2%. Just to underscore how much of an opportunity we get with these funds when the market goes crazy is the fact that IIM's 52-week low was $10.56. That would have absolutely been a time to load up on the stock. I'm going to hold off on buying any more of IIM until its discount to NAV climbs back to at least double digits. The fourth and final muni bond fund I own is Eaton Vance National Municipal Income Trust shares, ticker symbol EVN. As I record this video, I own 5,709 shares of this fund, and those shares pay me $272.32 per month. My taxable equivalent yield is 7.6%. And even though it looks like it's trading at a 10.6% discount to NAV right now, I've got to point something out here. This data we're looking at is actually 1 day delayed. Today, EVN is up about 3%, which brings that double-digit discount, which was compelling, back down into the single digits. So we actually had a better buying opportunity yesterday than we do today. Guys, I want to be completely clear about something. I am far from an expert when it comes to municipal bond funds. I'm not an accountant. I'm not a tax consultant. I'm not a financial advisor. I am an investor and an entrepreneur, and I'm often looking for opportunities to put my money to work for me that will give me the results that fit my goals as an individual. Sometimes those goals are growth, but they're usually focused on income, safe passive income. The reason I'm talking about my own investment and sharing them with you is because I want to inspire you by sharing my personal experience with growing my passive income stream. As I mentioned before, this has been life-changing for me. I'm now getting about $80,000 to $100,000 a year in passive income. So I've got some experience in this area, and I've learned a lot of things along the way that I think can help others who are also looking to build passive income streams. So my hope for my role on this channel is to complement what Jason is doing. I want to introduce you to income ideas that look timely or that you may have never heard of or considered before. And I want to be transparent with you and show you what I'm actually buying in my own portfolios, what investments I'm jumping on now. This is something that I think just offers a ton of value and that I wish I had as a resource when I first started getting really serious about investing about 15 years ago. I made plenty of mistakes with my portfolio early on that could have been easily avoided if I was following someone with experience and whose investment strategy fit my goals better. Again, I may be in a totally different position than you are, and so just because I invest in something or think it's a great buy doesn't mean it's a great investment for you. You have to decide that or talk to a professional who is trained to help you and can work with you on your own customized personal portfolio. All of that out of the way, there is still benefit in watching and learning from others, so I'm going to invest $2,000 into one of the 4 muni bond funds that I just went over with you. I already have relatively large holdings in each of them. I've got about $96,000 invested in NVG, $82,000 invested in NEA, another $82,000 invested in IIM, and about $75,000 invested in EVN. So in total, I've got about $335,000 invested in these 4 funds. I want to show you how easy it is to actually get invested in a muni bond fund like one of these and to start collecting monthly income immediately. And so I'm going to show you my screen as I actually buy another $2,000 worth of one of these funds. Now, this may surprise you, but I'm going to be buying more shares of EVN right now. I'm buying on portfolio balancing and position sizing, not on valuation. Like I said, shares are up about 3% today, which means the double-digit discount to NAV that the fund had yesterday just disappeared. So I'm not buying on valuation. Don't follow my lead here. I'm buying because EVN is my newest muni bond fund holding, and I'm still really building it out. I want to catch up my position sizing to the other 3 muni bond funds I own, and so investing another $2,000 right now helps a little bit to do that. I first bought EVN back in March after the market went nuts, and this fund, like a lot of others, dropped big time. I jumped on the opportunity and was able to buy shares for less than $11 each, which gave me a massive yield on cost. Obviously, I now wish I had invested a lot more into the fund back in March, but I didn't, so I'm just going to keep chipping away at accumulating shares of this fund until my position size gets a little closer to the other 3 funds I own. That out of the way, I'm going to go ahead and show you as I invest another $2,000 into EVN. Okay guys, that is it. That is how easy it is to invest in one of these funds. With this investment, I now own 5,862 shares of EVN. I increased my annual passive income by $87.57. I know that doesn't sound like a lot in the grand scheme of things, but every time you can accumulate any number of shares, do it. Accumulate shares of high quality, income paying securities as often as you can, and over time, you will just keep building on your passive income stream. Skip Starbucks a couple times, buy a share. Skip a dinner out, buy 2 shares. It's a small sacrifice in the short term for building a passive income stream that can potentially last you for the rest of your life. There was a time when I was only getting $10 a month. The most important thing to do is to just get started, make your first investment, and then keep at it as much as you possibly can. Last thing, and I will let you go, just for full disclosure, I do not only invest in municipal bond fund. The majority of my portfolio is actually made up of high quality dividend growth stock. I actually generate most of my passive income from dividend growth stock. I also sell covered options to generate income, and I own 2 rental properties that generate income, which isn't entirely passive, but it's pretty close. So I'm trying to be diversified across my passive income streams. In future videos, I can show you guys my dividend growth portfolio. I can walk you through how I'm selling call options for huge passive income and more. I can show you what I'm doing in real estate and what I plan to do there. The sun has really changed since I started this video. All of that ahead. For now, I think we are good. I hope that you enjoyed this video. I hope you got something out of it. I hope you're inspired. More importantly, I hope you learned something and that you can take something with you as you start or continue to build out your own streams of passive income. That's it, guys. Thank you very much for listening to me go on, and I will talk to you soon.